Good afternoon and a very warm welcome to all the participants joining us for this webinar on Best Investor Presentation. On behalf of the committee, I would like to welcome every participants, the learned panelists, as well as our speakers for the day, Mr. Deepak Goyal. Before I hand over the baton to the moderators, it falls upon me on behalf of the committee to introduce our distinguished speaker for the day and our learned moderators. Our speaker for the day is CA Deepak Goyal, sir. CA Deepak Goyal is a seasoned finance leader with over 23 years of experience across banking and financial services, telecom, and power sectors in multi-billion dollar organizations. He currently serves as the Chief Financial Officer, leadership team member, and board member across group companies. A transformational change leader, he specializes in technological implementation, business transformation, data driven decision making. His expertise spans in mergers and acquisition, disinvestment, financial strategy, treasury and cash flow management, controllership, taxation, regulatory compliances, investor relation, and board governance. He has successfully led process engineering, automation initiatives, cultural transformation programs, delivering significant improvement in efficiency, cost optimization, and decision intelligence through advanced analytics and automated dashboards. He brings strong expertise in business valuation, acquisition due diligence, and financial restructuring. His contribution to the finance professional has been widely recognized, including being named as CFO of the Year 24-25 by CII in BFSI segment and CFO 100 awardee in 2019. We welcome you, sir, for this webinar, and thank you so much.
Thank you, Samandeep, for the kind introduction.
Now, I would like to introduce our first panelist for first moderator for the day, CA Kuldeep Kothari. CA Kuldeep Kothari is a chartered accountant with over 15 years of experience in financial reporting, corporate governance, and regulatory compliance advisory. He specializes in advanced listing entities in financial reporting framework, integrated and ESG reporting, Ind AS and SEBI LODR compliances. He actively contributes to the profession through several roles within the ICAI, including Deputy Convener of the Financial Reporting Framework Group and Deputy Convener of the Tax Audit Quality Review Board. He is also impaneled as a technical reviewer with the FRFB and TAQRB and as a peer reviewer with the Institute. He is a recognized author, researcher, and speaker on topics such as Financial Reporting Framework, SEBI LODR, Integrated and ESG Reporting, Ind AS, and BRSR. He has co-authored publications on financial reporting, common reporting errors, and authored various governance research reports and contributed on investor awareness and financial literacy programs. We welcome you, Kuldeep, sir, for this webinar, and thank you so much for joining us.
Thank you, Saman. Thank you for the warm introduction.
Last and not the least, another moderator is CA Vrinchi Nandula. CA Vrinchi Nandula is a finance and compliance professional with over 15 years of experience in compliance audits, accounting, financial reporting, and advisory segments. He has extensive exposure to listed entities in India, as well as US SEC reporting frameworks, with strong experience in managing complex regulatory and financial reporting assignments. He has worked on cross-border projects involving organizations across the United States, China, Taiwan, Europe, and Southeast Asia, and has hands-on experience supporting startup companies in building robust financial reporting processes. His industry exposure spans in technology, manufacturing, EMS, automation, infrastructure and real estate, logistic, transportation, and media sectors. He has also completed international secondment in US for 6 months, further strengthening his global professional experience. In addition to client engagement, he has also led learning and development function of the large office, conducting knowledge sharing programs. We welcome you, sir, for this webinar, and thank you so much for joining us.
Thanks, Saman. Thanks a lot.
And with this, I formally hand over the baton to our learned moderators for the day. Please take it over, sirs. Thank you.
Samandeep, and with permission of all the other moderator, may I request one thing? I think it will be helpful, it will add some value to the discussion if we can understand the profile of participants. So is it possible if we can enable chat box and all of you can just add the kind of profile you are looking, handling, or the kind of things you are interested in? It will help us, in customizing or maybe ensuring that the discussion is more meaningful for the kind of profile or the audience we are addressing to.
The chat is enabled from our end.
So my request, if you can simply add the kind of profile you are handling, it will be helpful. So let's take 2 minutes and then maybe we can go ahead with the discussion.
The participants are requested to please put in their profile in the chat for a better learning experience for everybody.
So maybe what Deepak sir has said, in addition to profile, maybe the role he intended to say that the role that they are handling in their organizations, or maybe as in consultants or whatever, so that the questions or maybe the flow of the today's webinar will be customized or modified accordingly. That is the idea.
So we've got 3 responses so far: CFO, in Treasury, front office, CFO, FP&A. Okay, I think we've got some 20 response so far. So it's a mix of all sorts of profiles: CFOs, advisors, people in practice, internal auditor, treasury, front office, back office. Thank you very much. I think this is really helpful in terms of understanding who we are addressing to.
We can start, Virenji.
Sure. So I think just to begin with, from an overall context perspective, let's just step back and see from today's topic standpoint how significant is investor presentation and what we are trying to achieve out of the session. So undoubtedly, investor presentation is playing a very key role in corporate communications. While the primary source of information today for any external party from a data perspective are financial statements, annual reports, and regulatory filings, uh, the from a investor presentation standpoint, there is a lot of context that we get to look story beyond the numbers, and you also get to know what are the key drivers of the financial performance. A lot of times even the strategic direction of the company is being laid out in the investor presentations. Investor presentation is also acting as a very effective bridge between the formal financial reporting as well as management's explanation of the business performance. Now, one unique thing about investor presentations today is that they are not governed. The format of investor presentation is not prescribed by SEBI or any other regulators, which also means that companies today across the sectors have can design their own presentation to suit to their industry needs, to their investor base, including aligning to the management philosophy or style we can call. And this is actually allowing a lot of companies to showcase their story more effectively. Having said that, there are also certain challenges in ensuring consistency, governance from a transparency standpoint, including how the business drivers or performance metrics are used across sectors and across fragments. Now, the other important aspect is as we speak more to analysts and market participants, including institutional investors, one thing we are very clear is that the story behind the numbers is one of the key drivers where why people would want to look at the investor presentation, including understanding what is relevant, especially from a business metrics perspective when they look at these presentations. So with that particular context in mind, what we are trying to achieve in today's session is to explore how can we structure the investor presentations better, what are the best practices in communicating the performance drivers? How can non-GAAP measures and KPIs be used effectively to communicate the business aspects of it? And finally, how can you strengthen the investor presentation as a whole? With this particular backdrop, I can hand over to you, Kuldeep, and you can set the overall context for today's session. Thanks.
Thank you, Virenchi, for setting up the context of the session, I would say, and giving me the baton to take it forward. And then we all are eager to hear our keynote speaker of the day, Mr. Deepak Goyal. So before we move on to Deepak sir's, I would say, keynote speech, let's, as you said, let's go back to, I would say, 10 or 15 years. Let's travel that journey of the past, and you will see, we will be able to appreciate the fact that how investor presentation, or I would say in broader sense, corporate communication has evolved over these years. So it is, earlier it used to be merely slides, or I would say a presentation of what financial numbers are. And now it is replica, it is a reflection of what your strategy, what your operational drivers, and what your sustainability measures are. And it is very, very important in terms of communicating the narrative story, as you said, and an important tool by which the investors or those who are looking at the company, tracking the company, are able to understand and able to gauge what is going on within the company. Because see, every quarter companies are publishing the results by virtue of SEBI's mandate. Quarterly results they have to give, half yearly they are giving, and then the auditor results are given at the end of the year. But what is, when we say that investor presentation is acting as a bridge between the investors, or the expectation of the people who are sitting on the other side of the table and those who are running the company, it is actually serving their job. But it is on the other side, it is very, very important from company's perspective also, that whatever information they are giving in these investor presentation. So point number one, that headwinds and tailwinds both should be there. Point number two, that see, there are some cases which we will discuss on maybe through questions or through Deepak sir's keynote speech, that there are some cases where we see the selective emphasis is also there. You talked about non-GAAP measures, you talked about operational drivers, you talked about business performance. So all in all, it is an I would say a document which will consolidate, or which will narrate the story which has happened during the period, if it is for a specific period. And there are some cases, there are annual presentations also which entities are giving. So I feel all in all, along with the financial drivers, sustainability KPIs are also very, very important. Operational KPIs are very, very important, because financial numbers are one thing which everybody is looking at. But more than that, I think business, as well as how the business is being conducted, is something which is more important in terms of the understanding of the investors. Because we all are chartered accountants, and maybe the investors who are used to of looking at these presentation, annual reports, or other documents which are being given by, designated by the companies, they are able to understand the financial numbers. For them, it is very, very important that they understand the business context rightly, and the story which is being communicated by the company. So with this, we'll not come in between Deepak sir's speech and the audience. So over to you, Deepak sir, for your keynote speech, and then we will have a structured panel discussion in form of question and answers.
I think the context is correctly set by Virenchi and you, Kuldeep. Okay, so first of all, as in any investor presentation, there is a safe harbor clause. So let me use that safe harbor clause here also. While I am working with Bombay Stock Exchange, BSE, and people may get an impression that whatever I am going to talk is BSE's view. So let me add that disclaimer. These are whatever we are going to discuss in next 1.5 hour session, that those views are my personal views and not necessarily represent BSE's view. I may have access to some information by virtue of what our other parts of team does, right? While there is a clear Chinese wall, so I may not have access to exactly what they do, but based on some whatever can be shared is definitely gets discussed. So I may have some information as to what kind of things people are doing, practices which people are adopting. But beyond that, whatever we are going to discuss has nothing to do with BSE. So I just happen to be there, and all the views are going to be my personal views. So that's first safe harbor clause we should start with. So that itself is a best practice in any investor presentation, right? Because investor presentation includes many forward-looking statements. Management likes to discuss their plan sometimes, how things are going to pan out. They discuss various things. Kuldeep, as you rightly said, sometimes they like to discuss tailwind, but they forgot to discuss headwinds. So ideally, in a good investor presentation, there should be, management should discuss both headwinds and tailwinds, because as you and Vinci also said, investor presentation acts as a bridge between what story business wants to communicate versus financial number, because financial number does not reveal the whole story. Financial numbers are guided by LODR format, by division 2, division 3 companies act format. There are certain limitations. If anything is presented, that has to be audited by or reviewed by auditor, depending on when numbers are getting presented, has to be adopted by board. So in that sense, investor presentation acts as a bridge and is a very, very important document in terms of communicating the vision of management, what they want to achieve, how they see various things panning out, and how on various business parameter and factors, operational factors, management has performed. So I think that is what I would say. We can start with. That's a good starting point to discuss, and then we can go ahead. Based on what you ask, what kind of questions you have, we can elaborate more and discuss more on this, or we can build on this foundation.
Perfect, Deepak. Thanks for setting the context clearly from your end as well. So I think we will, without any further delay, let's dive into the questions that we want to engage with you today. Just to begin with, whilst we have a context, we want to explore more in terms of understanding the real essence of investor presentations in capital markets today. Today, while there is a lot of information available about any entity, be it continuous communications from the management side, and also the regulatory reportings that the management files day in, day out, how do you think the investor presentations particularly help in shaping the market perception, or do you think they really shape the market perception with a lot of data points coming in? Or you think it is only a communication tool? I mean, how do you view this, Mr. Deepak, in this particular context?
So, Vinci, you talked about regular communication during the quarter and various filings with the regulator. Filings with the regulator may not necessarily reveal all the or may not touch upon all the parameters. I would say whatever filings are done with the regulator or communications, necessary communications which are made through exchanges or otherwise, those are more of regulated disclosures, which are bare minimum, right? Business is not about bare minimum. As I said, regulations are designed to ensure minimum communication is there. But if there are businesses which are more transparent, there are businesses wants their investors to be more aware. They want investors to appreciate what management is doing, and in that, in narrating that story, I think investor presentation plays a very, very important role, because we have seen investor presentation of companies like Bajaj or HDFC. I'm not endorsing anybody's investor presentation, but they give a whole lot of story what they are doing. In recent quarterly results of Bajaj Finance, they had described how they have utilized AI to the benefit of business. That itself is a very great story, and I know that entire thing went viral and was widely discussed in whole media. So in that sense, yes, investor presentation plays a very, very important role in communicating the story. Quarterly minimum disclosure may not be able to meet that requirement sufficiently. I would say, what is the difference, whether you should make lot of disclosures in investor presentation, or you should present lot of information? I wouldn't say volume is important. I think relevance is what you are presenting, whether that is relevant for business or important for business, whether that is narrating the whole story, whether that is able to communicate, establish that link of understanding between investor and the management. That is more important, that's more relevant rather than communicating the volume. In fact, it's the other way around. I would say if you dump investors with too much information, that becomes counterproductive, right? Then people actually are not able to differentiate between the wheat and chaff, and they get lost. I think the same thing happened with one of the regulation which regulator brought in terms of disclosure of related party transactions. There were a hell lot of information which were asked from companies to disclose. The number of information which were there, whether it was to be given to disclosed in as part of LODR to exchanges, or was to be submitted to auditor audit committee or to shareholder for approval. Number of disclosures were there, but if you are not making the relevant disclosure, you are saddling people with number of information, it won't make any sense. So therefore, information should be precise, should be relevant, it should establish the link between management and investor. It should narrate the relevant story. I think one more important thing is consistency is very, very important, right? Kuldeep talked about headwind and tailwind. I would also go one step further. Not only headwind and tailwinds are important. Sometimes what happens, some managements have, they show some KPIs which shows the rosy picture, and they silently dropped it the moment things starts going southwards. So consistency is very, very important. So what happens while one can then debate that there should be some regulation or some governance mechanism should be there to ensure that investor presentation are presented in a particular manner. I would suggest, more you regulate, more you try to introduce regulation, it becomes burdensome, and then again we start moving towards minimum disclosure. It should be other way around, where people are given freedom to choose what is relevant for their business. They are allowed to disclose what is relevant for their business. There should be consistency, as I said. Then it should be left to investors. So what happens if a good management continues to present the KPIs which are not looking good, right? Investor pose a significant amount of higher trust compared to a management who silently drops KPIs which are not presenting a rosy picture, which are presenting a bad picture about the company. So it's also for the investors to look at investor presentation very, very, very carefully, look at the consistency in case these kind of signs are there where unfavorable or uncomfortable things are management stops disclosing. It helps them forming a view about the management of the company, isn't it? So consistency is important. I don't think there is a need for any regulation, so there should not be any regulation. People should be allowed. It should be voluntary, and all the relevant information is more important than volume of information.
So I think on a very related note, since we are talking about how the investor presentation would influence the market perception, now who do you think are the real readers of investor presentation? I mean, today the system would have been quite matured, but generally, based on the understanding that I am getting, mostly institutional investors are the users of the investor presentation. I mean, in that sense, what sort of perspective you have in terms of who are the real users of the investor presentation, and how should one look at, companies should look at the principles on what they have to incorporate in these investor presentation to suit to the wider use of the audience, particularly maybe the major fraction of who are the readers of these investor presentations. Some thoughts around that, Mr. Deepak?
No, I think the straight answer to this will be investor presentation is meant for investors, isn't it? But I think the answer is not that straightforward. It's a very there is a very layered answer to it, I would say. there are multiple stakeholder or multiple people who are the consumer of investor presentation. Investor is one big terminology which we use. As one of the stakeholder you talked about is institutional investors. My personal opinion, I don't think institutional investors are such a large consumer of investor presentation today. Okay, there are buy-side analysts who are the biggest consumers of investor presentation. That is my view. Of course, it is also looked at by retail investors, not in that great depth. Probably they are more looking for narrative rather than getting into various factors. Then there are, I think, not only buy-side analysts, some long side or other investors like insurance companies, mutual funds, etc., etc. They are also looking at investor presentation to form a view whether they can continue to hold the scrip, whether the long-term story of the company is intact or there is some change. So the way each one of them look at investor presentation is very, very different. So I'll probably go into for each of the individual stakeholder, according to me, what is more important. Other than this, today, even I would say bankers and lenders or the investor in debt security of the companies are also looking at investor presentation. So it's not only for equity investors, it's also meant for debt investors, which is relevant. What I've heard, and this is not a first-hand information, it's something which I've heard from others. Even income tax department has started looking at investor presentation, because the kind of narrative which companies are making investor presentation is very, very different from their tax filings. So they are looking at that also. So for retail, for individual taxpayers, the way they are looking at Facebooks and other social media, etc., to make sense whether their lifestyle is matching with their tax filings. Similarly, they are looking at the kind of story which is being narrated in the stock market, whether it is also making sense or it's similar to the tax filing. So that those are also the people now who are looking at investor presentation. Maybe let's get into the the individual stakeholders first. So institutional investors, people who have who are taking calls on a company for longer period, let's say 7 year, 8 year, 10 year, or mutual funds who are taking may not be taking call for 7, 8, 10 years, maybe taking for 2 year, 3 year, 4 year horizon. They are looking at company very, very differently compared to, let's say, buy side analysts who are giving target on quarterly basis versus retail investors. So as I said, first institutional investors, mutual funds, etc., they may be looking for signs. If there is some stress, they look at change in the language of investor presentation. So if, let's say, in a particular quarter, management may give very very bullish commentary, in next quarter, while they may continue to show very good numbers, they may continue to show all rosy KPIs, but still that narrative changes, that story or changes from bullish to slightly optimistic or cautiously optimistic kind of word. Definitely their view changes accordingly, right? And then the position they want to take for their clients, that changes. So they are looking for different kind of signs. Now let's come to buy side of an analyst. Buy side of analyst are, I would say, the most hardworking class in the lot. Right? They have their Excel sheets ready for each industry. They have their own model. The moment your results are out, everything will be punched in. Looking at the investor presentation, they would want to make a view how next 2 quarters, 3 quarters, 6 quarters are going to look like. What are the parameters which are going to impact the company's performance for next 4 to 6 quarters, 8 quarters, and accordingly how the profit is going to make a move, and basis that then they would want to revise their target. So you would see the moment company's results are out, within a couple of hours they will have their targets revised, either downward, upward, depending on what kind of narratives is there and what kind of commentary company has given, the factors which are being disclosed. Retail investors, this is my understanding, most of the people may not be that educated. While we should not underestimate the capability of retail investors. I think they are also very, very capable, but they may not be able to understand the number and accounting, the way it is done, etc. in that greater detail. So they basically look at only the narrative which is being made in the statements which are being made by the promoter. So there the promoter, I think, has to be very, very careful. So they are not looking at how the commentary has changed from previous quarter to this quarter. They are looking at the narration or the story which is being given by the management in that particular quarter, and basis that a view is being taken. So the three audience is very, very different. Similarly, as I said, there are other stakeholders also, maybe bankers. They are also looking at whether the debt has gone up, whether debt is serviceable, not serviceable. Therefore, accordingly, whether they should be asking for more collateral, or they should be taking the call on the company to increase the credit limit or decrease the credit limit. So the whole lot of risk management. Another class could be rating agencies. I think rating agencies are also looking at specifically when it is not a solicited rating. They are also looking at investor presentation very, very carefully these days.
So that's beautifully described, Mr. Deepak. Thanks for elaborating it. I think the other dichotomy which the companies will have now, because there are different agendas of different users of the investor presentation. How should I message my investor presentation today? What should I package in an investor presentation? What message I am going to pass? Is it purely going to be the quarterly performance, or is it going to be indicating the long-term view of of the management or strategy? What do you think should be the ideal messaging of investor presentation? Because there are wide variety of users, or if the answer is not one, how do you kind of strike a balance with different contexts for different companies in this particular domain?
Mm-hmm. See, I think if you look at most of the investor presentation in India, most of them basically talks about the kind of management they have, their capabilities, the kind of board they have, the kind of governance practices they have. Besides, this is obviously besides the numbers and the operating parameters. So that is what most of the managements are doing. They are obviously disclosing all the financial numbers. They are trying to disclose various other parameters which describes those financial numbers, like adjusted EBITDA, operating profit, ROE percentage, which are currently those are not disclosed as part of LODR format or as a part of financial results. So that's another thing which most of the managements are disclosing. That's one good thing to do. Another thing which people are doing, probably that's where management has to look at. Sometimes they are not very, very consistent with what they are disclosing as segment result in financials versus the segments which they choose to show in the investor presentation. Right. So there, I think there has to be some consistency. There should be consistency in the segment. If they believe something is important for their investors to, the segmentation is important for their investors to understand their business, I think the similar kind of segmental result they should be publishing in financial result also. So this is something which is lacking today. We have seen companies, which clearly says, they are operating only in one segment, and then when it comes to investor presentation, they'll choose to show split their result into 3, 4, or sometimes 5 segments also. I can give you example of one hospital company, and when they publish their financial result, they only show they are operating in one segment. But when it comes to investor presentation, they will be showing OPD separately and inpatient department separately, and then surgery separately and whatnot. So I think there has to be some consistency. One that is more on regulation side, I would say probably institute has to guide more or bring some guidance on that side. But yes, I think it is important that whatever management believes is relevant for investors to understand their business better, they should create those many segments and present their results and operating parameter underlying what is driving them, whether positively or negatively. Other than that, what I suggest, which most of the managements are not doing, well, they are disclosing financial numbers driving them, operating business parameters. They are not disclosing what drives those operating parameters or the underlying assumptions behind that. So if a company is disclosing, let's say, there has been a change in, let's say, if we are talking about hospital company, if there has been a change in number of surgeries performed, what is the underlying parameter which is driving that? Right? At the same time, when they are making any forward-looking statement that they see significant growth in the surgery segment, then what is the underlying assumption in that? Because the moment you start disclosing those things, then it becomes very, very important, easy for investors to understand to comprehend if something changes in the external environment. Because we started with a safe harbor clause. Why the safe harbor clause is there? Because it's not possible for management to come again and again the moment there is a change in external environment and disclose the impact of it. Right? There is no regulation, and it's not desirable also, because it's not possible for management to come out and disclose. But the moment you start explaining underlying assumptions, then people are smart enough to understand the impact the moment they see something is shaping up, right? If Iran war is breaking out, if people understand what are the underlying assumption driving a particular business behavior, they will understand how Iran war is going to impact the business, whether positively or negatively. So today, people are taking view basis what I would say, the intelligentsia is doing. Retail for retail investors to make sense of business behavior is very, very important. The company should also start publishing underlying assumption. That's one thing. I think otherwise, as I said, most of the whatever they should be there in a good investor presentation. Most of the things are getting published. And the topic which Kuldeep had earlier touched upon, if there are tailwinds, then headwinds should also be published. I think most of the managements are not doing that. People are trying to see, investor presentation is only showing the rosy picture or depicting the rosy picture of the business. There are very, very, I would say, limited management who are very, very proactive in terms of presenting or disclosing factors which may impact the business negatively. We have seen companies, predicting or showing or giving a forward-looking statement of getting a very good business outlook, raising money, and then after 2 days they come and disclose that something has gone wrong, and now they may not be able to achieve the guidance. But again, if you start publishing headwinds also, that creates kind of confidence, which is very, very important and required for a long-term sustainable growth and development of capital market for the company, I would say.
So we started from perception, and then we are discussing what to be disclosed and what not to be disclosed in an investor presentation. So you mentioned a lot of things during answering past 2 or 3 questions. You discussed about materiality. You discussed about not investor presentation should not be regulated. That is correct. Should not be regulated means there should not be any foundation in terms of what is to be given, because purely it is about communicating the real story. Then you talked about freestyle investor presentation rather than putting it in any tabular format, etc. And very important thing that you touched upon is I feel that segment thing that you mentioned, it is very, very important. We see it in a lot of presentation that at the time of publishing the final results, the scenario is different in terms of putting the numbers in one place or one table. And when they are presenting these investor presentation, it is totally different. So though you have answered my next question or our next question in by way of explaining these things, but again, I'll, for the sake of asking and for the sake of the audience, I will ask this question. People will say that we talk about operating environment, we talk about operational drivers, we talk about what is impacting the business. It is given in MDN. MDN is a annual thing which is given by the listed entity. Then you talk about financial numbers, it is given in the financial statements or maybe the format which SEBI has prescribed. Yet, do you feel that there is a need of having investor presentation? Question number one. And second to this, if it is so, then how an investor presentation can complement financial statement, financial results, and MD&A?
See, I think the purpose of MD&A is very different. First of all, the frequency is also very, very different. MD&A is only a once in a year affair, which is published as part of annual report, and that too, annual report also comes out with certain lag. These days we are living in a world where people need quick information, and that rightly so. If we are living in internet age and now in the world of AI, where analysis is also very, very fast. So availability of information has to be really, really fast. Therefore, the purpose of MD&A is different, and purpose of investor presentation is very, very different. As we discussed throughout last 40-45 minutes, the investor presentation is supposed to act as a bridge between what management wants to communicate to investors. So therefore, it is very important, and it should continue. As far as quarterly results are concerned, the quarterly result serves its very, very limited purpose because it's in a certain format, and therefore those number needs deliberation, explanation, which only you can say an explanatory statement. So investor presentation in that sense also acts as an explanatory statement to financial number, which is not possible otherwise to do in the LODR format or in the quarterly results.
So, sir, when we talk about investor presentation, you talked about materiality also. So, before Virenchi is ready with the next question, a sub question to this, that when you talk about materiality, there is regulation 30, and which RPT regulation you very rightly mentioned. As in terms of SEBI LODR regulation, we are on a roller coaster ride, which is continuing from 2023, and it is going on in terms of what changes they brought in various regulation, various disclosure related requirements. So do you feel that the materiality regulation, which is completely different in terms of context, because material events and investor presentation is totally different, but you feel that there should be a concept of materiality while selecting the KPIs in an investor presentation?
So, we discussed about this. Regulation is important because regulation ensures bare minimum. Right? So when you talk about materiality disclosure through SEBI or even accounting standard talks about whatever is required to explain financial results should be disclosed in financial result. That also basically talk about minimum disclosure. Right? Good part of investor presentation is it does not restrict. Managements are not restricting themselves to only minimum required. They are going beyond minimum required, and that's the beauty, and therefore it's important. Right, in investor presentation. And first of all, see, regulations cannot define everything. Regulation provides a framework. So when a regulation says for a related party transaction, more than 1,000 crore transaction should be sent to, let's say, shareholder for approval. It is for they can provide only bare minimum. I will say, for example, in our case, while SEBI prescribes a limit, we deliberately we have opted for a lower limit than what SEBI prescribes. Right, for related party transaction approval. So, every business is different. Regulation provides for minimum disclosures, minimum materiality threshold. Business believes, no, this materiality threshold is too high for me, and it is important for them to disclose some other parameter which may not be material as per the regulation, but otherwise it is important. And if it may not be important today, but that may have significant impact on the future of the business, because investor presentation is not only about today. Investor presentation, how things have been in the past and what management is thinking about future. Investors are taking view about future. Right? So it's very, very important that it's not only about sticking to what is prescribed as the material transaction, and also depends on management. I would suggest say that management has to decide what is relevant and should go beyond what is specified as bare minimum.
Sir, one last question, Virenchi, one last question related to regulation only. So when you talk about investor presentation, investor con calls, there are 2-3 small, I would say, regulations which are there. One is that prior intimation to the exchanges, that is 48 hours, then uploading the audio and video transcript within 24 hours, and then the written transcript within 5 days. So do you feel that these timelines are very much relevant? They should be modified. What is your view on these timelines?
See,
And
again,
what is the relevance?
Kuldeep, there is, I would say, significant relevance of all these timelines. See, the very purpose of investor presentation, or for that matter, of any disclosure. I mean, now in this case, I would come to the whole lot of disclosures. Not only, I will not limit myself to only investor presentation. So, whole lot of disclosures. The purpose of them is to reduce the information asymmetry. Earlier, what used to happen when all these norms were not there, certain class of investors will have extra access to information compared to large number of retail investors or large number of small investors. So giving those specific set of investors and I would say extra advantage, and they could take positions either to sell or to purchase a particular script in before the time the larger investor community would come to know the purpose of this. And by putting those timelines, I think SEBI tries to achieve information symmetry, so that information should be available to all sorts of investors, not only to large investors who have got resources, who have got access to management. So when they say the before 40, at least 48 hours in advance, it should be intimated through stock exchanges that results are going to be published, so that that information spreads to all sorts of investors, interested parties, that information is going to be available on so and so date, right? When SEBI says that within 15 minutes or 30 minutes, results should be published from the conclusion of the board meeting. Again, the idea is very, very clear that information should be available to everybody. So it's not only for the management to publish it to the exchanges. Even for exchanges, there is a regulation that within few nanoseconds it should be available to public. Therefore, I don't know whether you guys have noticed, on exchanges also we publish the time of getting the information and disseminating to the public. So the public is available aware that the information has not been withheld by the exchange and it is published in a fraction of second. So it's available to everybody. So the purpose is to reduce the information asymmetry, and for that purpose, all these timelines are very, very relevant and very much required.
Virenchi, over to you for the next question.
Thank you, Kuldeep. I think you connected a very big dot between two important aspects as to the timing of the investor presentations, the frequency of the investor presentations, coupled with the information asymmetry that investors should have at a particular point in time. So that effectively means that information has to be given with more frequently, more engagement is required with the stakeholders, and the timing of that particular engagement is very crucial, so that one person does not get an unfavorable advantage over the other investor, which is kind of addressed in the present regulatory setup. That summarizes this very well, Deepak. Thanks a lot for that. I think one peculiar aspect which generally we note again in the investor presentation, more I'm focusing on the overall contents without getting into other specific like anatomy of the structure, etc. Some companies tend to give 5-year trends, some company tends to focus on quarterly trends, and some presentations more focus on KPIs in terms of very specific and in-depth analysis of their particular segments. So the narrative generally is wide range. I mean, what do you think defines the extent of narrative today that investor presentation should be guided by? I mean, a lot of CFOs on this particular session. It will be helpful to understand how should you determine the period at which you want to really want the incoming or potential investor or the existing investor to focus on, how this narrative generally gets shaped up.
I would say again, so it's not more to do with shaping the narrative. It is individual management's choice whether they want to show, for 2 year or 5 year or 10 year. It also possibly, I won't exactly know what goes through in the mind. It's also possibly to show the various cycles which company has gone through and how in different cycle company has performed, right? So if let's say a particular company has performed in a particular manner during COVID, that shows the kind of resiliency depending on whether it was performing good or bad or ugly. So possibly, people wants to show for a longer term when they want to show how company has performed during various cycles. So it depends on the intent of the management, I would say, because there is nothing called no, short period or long period. It depends on the intention of the management purely, I would say. Second thing is, if management has been consistently disclosing or making presentation, IR presentation, all these things are today available in public record. So if a company, let's say, even they want to limit themselves to presenting the number only for 2 year or 3 year, not showing for 5 year, 10 year, a smart investor can always go back to stock exchanges site or to various other sites and extract all those investor presentation and see how company has fared in various cycles, what company had said in previous investor presentation, whether they actually performed well, not performed as per the commitment or as per the statement what management had made. So today, it's not that the resources are not available. Resources are available. So it doesn't really matter whether company stick to presenting the number for long term or they decide to do it for short term. Resources are available. People can still dig out old information and make sense out of it. As far as management is concerned, depends on individual management's thought process. Only thing I can think of, if somebody is showing for 5 year, 10 year, possibly they are trying to show how company has performed over various cycles.
And just to complement what you said, Mr. Deepak, a very interesting perspective I've got from a analyst, that typically when company wants to attract probably institutional investors who would want to hold more long term, typically they want to depict the long term trends to resonate the growth story, like you rightly highlighted, in terms of how they are positioning, either probably because their existing investors are probably of that nature, or they really want to attract an incumbent who probably want to stick with the stock for a longer time. That's typically one trend which interestingly that was discussed. But I think from a narrative perspective, well, management as a free hand, how they decide to shape the thinking of the other person would drive in terms of what they will put it in that particular deck. Yeah. Kuldeep, you want to add anything to this?
No, we are good to go.
Perfect. So one other aspect is, and this is to do more with, I would say, on the structure of the presentation. Now, one general discussion that when we were engaging with analysts and other market participants is that obviously different investor presentations have different structures. Some of the large presentations have a very clear bifurcation of the macroeconomic factors. They talk about the key business performance drivers. They deeply engage in forward-looking factors, and then they talk about the ESG aspects, risk aspects, cyber aspects, and then there are a whole lot of things that they cover. And a lot of other companies we have seen are more heavily focused on performance metrics, maybe not so much and so forth on forward-looking statements. So the whole point here is this can be a industry specific trend, or this can be differences even in the same industry across companies, and we have seen both the trends. What do you think should be the balance in terms of covering all these aspects? Because each of the aspect by itself looks very fundamental to us. For example, macroeconomic factors, right? I mean, if I am the investor, would I not want to know the conditions under which they want to operate? Similarly, a narrative on the upcoming periods. I mean, it's more on the structure and not on a specific topic which we will engage deeply. But do you think how do you think companies should look at incorporating some of these aspects? Should all companies do this, or how should they be selective? Any thoughts around this, Mr. Deepak?
So I think to answer this question, I think we should go back to who the investor presentation is meant for, right? The various stakeholders who are looking at investor presentation. I would say, depending on the class of investor you are trying to address, management should choose what should be incorporated. And this is my personal opinion. This is not what I have observed various management, various companies doing. So for institutional investors, as I said, the difference change in narrative is very, very important, right? Institutional investors they have all the wherewithal. They understand macroeconomics very, very well. They understand what impacts what in the company. They understand the business very well. They have access to management, so they are not looking at how or what is changing in the macroeconomics. They understand macroeconomics very well. Probably what they want to understand is, depending on change in macroeconomics, how company's performance is going to change, or how the company confidence is going to change, management's confidence in being able to deliver various their plans. Not only I'm not talking about only profit. If, let's say, management is building additional capacity, depending on macroeconomic scenario, how that plan of building additional plant changes, whether the capacity utilization going to remain same, whether it is likely to come down. Because institutional investor is not only interested in next quarter's result, they are looking at slightly long term, because their horizon is 5 year, 8 year, depending on which institutional investor you're talking to, right? So they want to know if the utilization is going to be different, whether company is going to defer the commissioning of the plant, etc., etc. Similarly, when you are looking at buy side of analyst, they are more looking at short term, 6 to 8 weeks, 8 quarters, right? So the kind of narrative or the kind of information which they expect from management is very, very different, right? As I had spoken earlier also, for retail investors, and I am talking about larger community of retail investors, not the astute ones, the larger community of retail investors, they are looking at very specific guidance, right? They are not looking at just the change in macroeconomics. They are looking at very specific guidance. What could be the exact impact on the operations of the company in short term, long term, medium term, etc., etc. So I think that is my view. That is how, looking at individual investors class need, management should try to address the narrative, and there should be something or the other in the investor presentation catering to each class of stakeholders.
So, sir, when you say that the narrative should be addressed depending on the class of the investors, or maybe the class of the investor at the companies is looking at, so you are saying that management commentary should be an essential part, or maybe a must-have part of the investor presentation?
Most of the time it is. Most of the time, it starts with, as I said, how the management is placed, who are there, what is their capabilities, board management, what MD's views are or what management's views are. That's how normally all the investor presentation starts. Whether it should be mandatory or not mandatory, as I said, I think it should be left to individual company, because it is the individual company is the best judge of what they want to communicate to the investors, because it is their document.
Yes, sir. In addition to what is given in the beginning of the presentation, you talked about underlying assumption also. So maybe my question was that when you talk about any specific KPI, any specific matrices, whether financial, non-financial, GAAP, non-GAAP, whatever it is. So it should be, I can redraft in other way, that whether it should be mandatory in terms of putting these underlying assumptions or explaining that what a KPI means to the company, or it should be left to the company whether they want to explain or not.
Whether it should be mandatory or no, again, it's a matter of debate. I would say I would advise that yes, it should be there. Specifically, if you are using some terminology which is not very, very widely used in a layman's language, the management should take extra pain and define what they mean by each KPI, what are the underlying assumption, as I said, so that when management is not able to communicate and there is some change and there is some information, some news that becomes available in the market, people should be able to make sense of that information.
So, sir, when we talk about these KPIs or consistency, etc., is there any methodology which you have seen or which you have observed over the years of your vast experience, that how do a company identifies KPIs? What is the thought process? Is there any specific process which is there in the companies to identify the KPIs to be disclosed?
Generally, I would say from our own experience, we try to put cover as much information, which is one, it's not too much, because if we don't want to overwhelm the investors, so it should be relevant and should be able to explain the nuances of business, what has gone right, what has not gone right in previous quarter, and how possibly it may impact future business, while we clearly refrain ourselves or stay away from making any forward looking statement. But the idea is to make sufficient disclosure so people should be able to understand the implication in future.
So when we talk about long-term value creation, identifying the KPIs, which explains the business nuances as well as the financial numbers. So why I was asking this, you talked about some instances where some rosy KPIs or maybe some favorable KPIs were being shown, and as and when they are going in the other direction, they will be dropped, and they will be in the process of getting dropped. So is there anything which the company should keep in mind while identifying I'm not saying that we should be selective in terms of identifying the KPIs, but is there any specific thought process which you have that by this way we should look at picking up specific matrices? So I don't know as a company that while selecting in KPI, whether it is a business KPI, financial KPI, or non-financial KPI, that what is going to happen in future. So is there any thought process in your mind that the company should adopt while selecting these KPIs, or it should be natural?
No, it will have to be natural, because there can be a framework only, because each company is different, each industry is different. So some of the participants or audience here, I know, will be operating in manufacturing, some will be in trading. Even in manufacturing, one company will be different. Let's say company in dealing in commodities will be very, very different compared to company in FMCG, versus an IT company will be very different. A banking company will be very different. VA stock exchanges are somewhere in between. We are neither a banking company, but we are sort of a financial services company. We are very, very different. So each company is different. Therefore, there can't be a one set of KPIs which are relevant. Therefore, it is for the management only to choose. But yeah, the framework is very, very clear. We discussed this in last 50 minutes or so. Whatever is relevant for investors to appreciate and understand your business should be presented. That's the one line statement that should guide what should be included, what should not be included, and that should be consistently presented.
You want to add on something, Virenchi, on this?
Yeah, I think from maybe most of the group, maybe a well-learned group here is aware, but I just want to add that with ICDR regulatory changes got affected recently in April 2025, SEBI already mandated that in the prospectus they have set out clear guidance with the help of the IKF standards set jointly by all the three industry bodies, where SEBI has given a blessing to ensure that the framework of how the process of KPIs have to be selected, how the governance around KPIs have to be monitored, including reconciliation of how KPIs would span out to the financial statement. So a lot of guidance has already been given by SEBI under ICDR framework and not under the LODR. That is something which is right now not in charts. In addition, Ind AS 118, which is going to come and hit us probably from 1st April 27, if everything goes right, that also recently has kind of come up with very interesting angles on choosing KPIs, giving them as part of the financial statement disclosures itself. So there is a lot of buzz around KPIs with these recent regulatory updates, which probably provokes a thought, Mr. Deepak. Should some of these practices also be kind of assessed from a quarterly investor presentation perspective, in terms of either the governance requirements or reconciliation requirements? Do you think companies should start looking at some of these practices? I know very, very large companies are already doing it in terms of how they are structuring some of these documents, but given these recent regulatory updates, what do you think companies can kind of look at?
So, Ind AS 118 is prescribes very different requirement compared to guidelines which are given for choosing KPIs in prospectus. I would still say, no, the guidance which is given to choose KPI is still relevant for investor presentation for management. But it's again, I would say, for investor presentation, it will be more guidance, and management should choose their own, because even there it is bare minimum what SEBI expects management to do in prospectus. So that guide that basis cannot change when it comes to investor presentation. As far as India's 118 is concerned, there is again limited disclosure which is required. Today our P&L is more like a khichdi of everything, whether it is operating performance or investing performance or financing, impact of financing, etc. So basically, the intention of India's 118 is to segregate these three type of performance. So the P&L is clearly showing how much profit or loss is made from the operating activities of the company, the way it is done in cash flow statement. I mean, there can also be debate, like today's cash flow statement also does not present correct picture or may not present correct picture for various companies depending on the industry. Like for banking companies, cash flow statement does not present the way it is presented today, does not make great sense, right? So there can be views about the same thing when it comes to presentation shown in India's 118, but definitely it will be a great change or a significant improvement over the current way of reporting financials. And the reconciliation which is required is basically to show, today people are using various type of definition like EBITDA, adjusted EBITDA, EBITDA adjusted for ESOP cost, etc., etc. That does not, give any meaningful information to investor. Does not uh, allow people to compare various companies, because each one of them might have used different set of information or different formula. So India's 118 basically aims to bring that consistency in presenting the information, financial information.
So looks like there's some questions are there from participants, Mr. Piran and Mr. Lakshmi. Deepak, Mr. Deepak, with your permission, can we unmute them and allow them to talk?
Sure, please.
Yeah, I'm unmuting Mr. Piran first. Yeah, Piran, you are unmuted. Hello, Piran. You wanted to speak? We have unmuted you.
We have enabled the chat also, so the participants can please type in their questions.
Yeah. So maybe we'll move to the next participant, Lakshmi Priya. We can just unmute her. Can we unmute Lakshmi Priya Subramanian, Samandip?
Yeah. I think there could be some technical issue with their end. They're unable to.
Okay, I think then let's continue the session, and then maybe we would request participants to kind of text the questions in the chat box so that we can have the session facilitate your answers, whatever you require. Yeah.
So I think one question has come from Mr. Nishant, who is asking, how can companies ensure their investor presentation clearly communicates the business value rather than just presenting financial data? So Mr. Nishant, I mean, if you see, most of the investor presentation are going beyond financial data. They are looking at various factors which drives those financial data. If it talks about gross profit, they talk about operating profit. Though today, in absence of India's 118, there is no requirement to publish operating profit, etc., or EBITDA percentage or ROE. Still, people are going ahead and presenting those numbers. The only missing link today is they are not properly presenting how those numbers are being arrived at, and each one is arriving at their own definition. But if there are something good, people have to live with something which is not so good also. But people are going beyond financial data. Management are publishing various information which sort of allow people, investors, to make sense or appreciate the business drivers better, how company has been performing, what kind of initiative they have taken, how they are making themselves sustainable, how it is going to make their business more resilient, how things are likely to impact them. So as I discussed in the beginning of the webinar, Bajaj Finance this time presented a beautiful sort of case study wherein they have talked about how AI has helped them increase their conversions, etc. They have analyzed the transcripts of various calls they've been recording as part of their sales calls, and they have beautifully presented how it has impacted or created value in their business.
Yeah. And just to add to what Mr. Deepak already spoke, most of the companies are now using a narrative of how the business objectives are, unfound, are actually helping to lay out probably the quarterly results and the annual results or the growth story that they have had in the last 3 4 years. So they are unfolding strategies at high level and are presenting their business. I've seen this trend in FMCG and automotive where they are basically able to showcase what their particular philosophy of launching a particular segment of products, and they're able to talk about how their particular vision aligns to their growth strategy and revenue strategy, which is one of the ways of linking numbers to business. There are a lot of enough amount of case studies in this particular space.
So there is another question from Mr. Manoj Kumar Patra. He's written whether a large size and small size company approach to prepare the investor presentation in the same manner. My question is triggered by the fact that a large company can have many retail investors who may not pay attention to these presentation. Moreover, the presentation can be matter understood by the institutional investor rather than the retail investor. How is SEBI taking care of this aspect and how the company can design its investor presentation? I think some of these aspects, Mr. Manoj, we have already discussed during last 50-60 minutes. What I have observed or what we have seen, there is a significant difference in the level of sophistication in investor presentation between a large company and a small company. And it's not only in the way, in the look and feel, it's also in the nuances which large companies are presenting. Definitely it depends on the management also, but in general, if you see these days, in fact, for many years, large companies have been the ones who actually started with, possibly they took cue from what was being done in developed world like US and all. The most of the investor presentation were earlier started by IT companies because they were influenced. They wanted to probably show they had the best of the corporate governance, and they were very clear in terms of transparency and communication. And that's how it has followed. And small companies or mid-sized companies, I would say the phenomena of making investor presentation is very recent. I won't say 5 year or 6 year ago, if you go, not many mid-size or small size companies were making investor presentation. Possibly in 5 to 6 year, we are seeing there is an increasing trend where people, even the smaller companies, have started making investor presentation. It's a good start. There is a lot of ground to be covered. The level of sophistication nuances which they should cover is definitely requires some catching up. But yeah, I think I would say, despite the fact that it is not a mandatory requirement from SEBI side, people have still started thinking of making an investor position. That itself is a good start. The other question which you are talking about, that it is largely meant for institutional investor or being read by institutional investors and not by retail investors. So as I said, I think companies have to start, while they can't really create those segments, but they have to, if they start keeping those different type of stakeholders in mind and start customizing their investor presentation to have some or the other thing for each segment of the, or each type of class of investors, I think it will start making more sense for retail. So couple of slides, my advice, a couple of slides should be included in investor presentation, which explains business, what has happened, what has driven the performance, and how it is likely to perform in future in more narrative, simple language, which is easy for a layman to understand. It will be more useful for retail investors. That's all I can say, instead of just presenting tables and presenting complicated graphs, etc., which you rightly said is more understood by institutional investors and not so well understood by retail investors. Okay, there is a comment. So a listed company can choose not to have any investor presentation. Your answer is absolutely, the answer to this question is absolutely yes. There is no compulsion for any company to make investor presentation, at least in India. So it's completely voluntary. Only thing is, today most of the investors, any class of investor, they are looking for these investor presentation to understand business well. I would say this is also a sort of development of our capital market, where people have actually graduated from only looking at the number and looking at the quarterly performance to seeing slightly longer term and understand what management wants to communicate. So therefore, while it is not mandatory, but yeah, expectation of investor is there. So despite not being a regulatory requirement, automatically it sort of become an expectation, and therefore sort of becomes mandatory. There is another comment. In an era where attention is becoming the scarce resource, should investor presentation evolve from being document style explanation to more visual storytelling tool? I completely agree. But again, it depends on the class of investor you are addressing to. Institutional investor look for changes in the narrative. My understanding, buy side investor would be looking at more numbers, etc., because they have objective parameter to give a price target. So only storytelling may not be enough for them to form a view and then create, issue a price target. So depending on the, but yeah, storytelling is definitely required. It is very, very important to communicate how company has been faring and how it is likely to fare in future. Specifically for retail investors, you want to explain it to them. You want to explain your growth story or your story. It's very, very important to narrate that in a storytelling format.
There is one other question also, Deepak sir, from Mr. Vishweshwara Rao. How a retail investor can draw conclusions on business valuation, PE multiples based on investor valuation, like some key commentary parameters?
I missed you, Kuldeep.
So there is one other question: how a retail investor can draw conclusions on business valuations, PE multiples based on investor valuation, like some key commentary parameters impacting business valuations?
See, business valuation or P multiple, no, first of all, there is no science how much P multiple is right valuation or, higher excess valuation or a cheap valuation. It depends on, so valuation itself is an art. Valuation is not a science, right? The fact that trading exists, it exists because of this art. If it was a precise science, company X will have same value for you and me both, then there can't be a trading, right? Today maybe a Kuldeep's view can be different about a company than my view, therefore trading exists, right? If Kuldeep may think the company real worth is 100 rupees and I believe it is 110, that I would be ready to pay 110, therefore Kuldeep will be ready to sell it for 110. If both of us believe the real value is 100, there nobody will be selling, nobody will be buying.
Correct.
So therefore, it's very difficult. It depends on everybody individual's view, and then you also have to understand various methods of business valuation. I mean, I would say method of business valuation is still a formula, but how you arrive at future prospects of the company is more important than actually applying a formula for business valuation, whether it is P multiple or any other method, DCF or any other method you use for business valuation. So understanding how company is going to fare, what is their future prospect, depending on the kind of commentary company is making, is what actually helps you in forming the view about the business valuation and whether company is today is trading at lower price or higher price than the real value of the company.
So maybe Mr. Deepak, to complement maybe these questions, what they are asking, can you also explain to probably the attendees in terms of which sections in the investor presentation will help them to really assess, maybe hinting at valuation, if not exactly valuation, what information to look for to kind of nuance, understand the nuance of stock price discovery. Maybe that will help the larger audience here in terms of.
So there is no one single segment which one can say is relevant. That depends on the context. As I said, sometimes comparing two investor presentation can also reveal a lot about the company. If something was going good and they were actively talking about it, they were disclosing about their various plan of installing a particular plant, and then in the next investor presentation, all of a sudden a narrative changes. Depending on that, valuation may change, or you may like to change the valuation, right? If company has, if the installation of plant is getting delayed, that the capacity is not going to come up, or if the plant is going to come up but the utilization of existing plant has dropped between two investor presentation, then what's the point of having commissioning the another plant? So even if it is from long term point of view, it may not add revenue in immediate quarter. So depending on that, how market is going to shape up, how the market share is going to go up, how the utilizations are moving, one will have to form the view. So there is no one segment which is relevant. I would say the entire presentation is relevant. Sometimes even the change in the narrative or change in the numbers between two presentation is also very, very important.
Thanks for the articulation, Mr. Deepak. So, Deepak, we will continue, Kuldeep, in terms of the other sections. Yeah. So one other aspect is again more to do with what strategy that company should probably take in explaining the level of detailing on the business performance side, slightly from a narrative standpoint. Like we can pick any industry example, Mr. Deepak. Generally, what approach that management should probably take to explain the drivers such as pricing, demand, and cost structures? What level of detail has to be given, and how do management probably balance this level of detail?
I think we have discussed the same thing. I mean, again, guiding principle has to be, it should be sufficient. Maybe we can discuss investor presentation which is being made by Bombay Stock Exchange, BSE. That itself can throw some of the light. So in our in stock exchanges, how we drive revenue, what are the various products, what kind of volumes we receive, what kind of factors which are likely to impact those volumes in case if we are talking about derivative, what kind, how much revenue comes from derivative, what are the factors that drive business on the derivative side. All those things are projected, the macroeconomy, how things are impacting. Let's say a mutual fund transaction is a significant revenue driver for us. So we present how many mutual fund transactions we have processed and how it has been growing over a period of time. So today, in exchange process transactions, our market share is about 90%. So you can say BSE is practically the market in that sense. So that itself, that shows, if you look at how mutual fund, what kind of mutual fund transaction we've been processing over various quarter, that shows the kind of growth this industry has been seeing, and how depending on the financialization which continues to happen on different classes of investors which are getting added, number of demat accounts which are getting added, number of folios which are getting added, what kind of revenue BSE can expect to generate from in future from this segment, right? One can form that view. So as I said, all these relevant, all these whatever is relevant for investors to understand your business should be presented, and that has been the guiding force for us, and that's what we've been following consistently for past many quarters.
Yeah, so I think the key is using financial as well as non-financial gap measures in equal tandem so that you will be able to project the narrative very clearly. A lot of times, like you said rightly, Mr. Deepak, number of investors, number of users, number of transactions, these non-financial data points also would add significant value in understanding the narrative from a number perspective. So that is something which is to be seen from sector to sector perspective, and
Yeah.
those data points would play a significant role in bringing up the narrative. On a very related note,
Sorry to interrupt. But I would go one step ahead. It's not also actually that is the must, because financial numbers are anyways being mandatorily presented through financial results, right? So investor presentation, the very purpose is to publish the underlying factor, what is leading to those financial numbers, because financial result is just an outcome. That does not tell you the whole story. The idea is to tell the story behind the number, and therefore publishing those operating factors is very more important than just publishing financial numbers.
perfect, perfect. And just on a very related note, how would you also look at are any traps where companies would overly communicate promotional narratives, probably which could miss the business strategy? What could be those situations which companies should avoid, if at all, based on your experience, you have seen such kind of presentations? I know at the beginning of the session you did mention about overload of information, which will create probably more confusion than clarity. But uh, can you give us some specific nuances in terms of this particular aspect, to address this particular aspect on especially on the KPI side, maybe? Yeah.
So again, there can't be any single number, which defines what should be published. I would say, I know we have been discussing this one, but no, not only what has been relevant for this quarter or previous quarter. I think what companies should also focus is what is going to be relevant for coming quarters. So it's possible the company might have decided to diversify in another sector, right? Number of that particular segment may not be very relevant from materiality point of view to be published in investor presentation otherwise, but it makes sense for investors because what stock markets does or what capital market does is it is normally said stock markets are an instrument of discounting the future, right? Because they are not only looking at what has happened in past, they are also looking at how things are going to be in future and what kind of revenue profit earning potential is there with the company. So as I said, if the segment may be smaller in particular current quarter, but if it is a strategic priority for the company, or it is a segment where company is diversifying, or where the company is looking at the significant revenue to come from in future, those things should also be focused on, should be made, adequate disclosure should be made, or should adequate storytelling should be done. I mean, one example could be, I don't know if somebody is there on this forum from Reliance, right? A couple of years ago, when Reliance started focusing on telecom business, those days telecom numbers were very small, right? If we had gone only by materiality threshold point of view, it would have not made sense to publish telecom number. But today, you look at, it contributes significant profitability to the number of Reliance, right? Because they had shifted their focus. Similarly, now probably the focus is shifting on data business, focus is shifting on data center business. I'm sure that they're taking care of that. Of late, I have not seen investor presentation of Reliance, but I'm sure they are looking at their publishing and they are disclosing whatever is relevant for investors to understand how where the profitability is going to come from in future, and not only looking at the existing businesses.
So maybe, sir, what you are saying is that the companies should look at the vision as well as the strategy, what they are going to do in future while putting these numbers or selecting the matrices in the investor presentation. Hope I am correct in consolidating your views. So taking this one step forward, when we talk about business performance, we talked about financial numbers also. Let's talk about sustainability also. That how important is in terms of integration, how important is ESG KPIs or sustainability KPIs into an investor communication document or investor presentation document, as well as the other parts of.
I'll be a little honest today. I'm not sure how much investors are actually looking at sustainability parameter. While it is very important, I really believe, any component of E, S, or G, all of them are very, very relevant for the long-term sustainability of the business. Because if you are not cognizant of the society which is getting impacted or is impacting your business, in long term, there is no way you can sustain or you can survive. Therefore, all these parameters are very important. But at this point in time, at least in India, we have not seen, investors looking at. That's my personal view, and I may be completely wrong, and I reserve that right to be, proved wrong. But my own view is that at this point in time, at least in India, investors are not looking at ESG parameters in investor presentation, at least. While it's there as part of BRSR mandatory reporting from SEBI side in annual report, people are looking at it. Many rating companies have started publishing their rating. Companies are looking at improving, actively working on it to improve rating on it. But yeah, definitely, at this point in time, it's more compliance. But I believe, yeah, in sooner than later, it should become really, talk of the town, or the way investors should be looking at it. They should be definitely looking at how companies are performing on ESG parameter as well, because it's very, very important from long term point of view. May not be relevant in short term, but it's important for long term.
Correct. So before going to the next question, just one small thing I want to add on to this. You mentioned about BRSR. So BRSR is something which is applicable on top 1,000 listed entities by market cap. It is the formalized way of having or giving the sustainability reporting. So I feel that when we talked about alignment of financial numbers and the numbers which are being given, or the way of presentation which is being adhered to in the investor presentation, I think the sustainability KPIs are also required to be aligned in terms of what we are giving in BRSR. Again, BRSR is an annual reporting requirement, and then you will put some numbers quarterly related to all ESG factors. So taking this forward, do you feel that there are any specific important KPIs related to ESG factors which are important in terms of being disclosed, or maybe must have according to you, or the pitch is very plain in terms of companies are giving, or maybe somebody can give whatever they want to, or there should be any differentiation in terms of selecting these KPIs?
You are talking about selecting these KPIs and reporting for along with investor presentation quarterly.
Yes.
Okay. I would suggest, again, my personal view, the reason why SEBI has made it mandatory only for top 1,000 companies, probably because not all the companies have equal focus. I know many companies, who are not in top 1,000 listed companies, but still they are actively doing there are companies, for them it's more of a tick box exercise rather than actively doing something very serious stuff on ESG. So I would say at this point in time, maturity level is not that high that one should expect active reporting on quarterly basis along with investor presentation. But there are good companies who are doing some serious stuff. Definitely voluntarily choose some important parameter, and then they should start reporting it to investors. Because in long term, imagine if company's governance is very, very good, it's highly unlikely that they would be penalized by any regulator, or it can cause any serious threat of closure of business. If they are paying good attention, they are taking all relevant adequate measures to ensure their society is not impacted, there is again very, very high chance that they will continue to be in business. They will continue to command the respect of the public, and therefore their product will continue to get the kind of response they might be getting. Because if company is not taking care of society, or is making their product in a way which actually harms society, sooner or later their brand image will get tarnished and will have impact on their sales, and accordingly will start impacting the profitability. The bad part is that ESG does not impact profitability on immediate basis. So therefore, at this point in time, people may not be taking into that. The maturity level is not that high. But yeah, I would encourage companies should on voluntary basis start adopting some parameters which are relevant and start reporting on quarterly basis. There are many companies who are actually doing it. As I said, there are many companies where It's not even mandatory. Still, they have voluntarily chosen, and they are publishing as part of their yearly results, annual report, and they are doing very, very good job. I mean, the same thing goes for CSR. Many years ago, when there was no regulation, there were large groups who were spending significant amount of money on CSR, even when it was not mandatory.
So, sir, when we talk about selecting those ESG KPIs, maybe related to emissions, maybe related to diversity, or maybe related to governance, I feel that governance-related KPIs are, and they were part of the whole scheme of things since quite long. But environmental as well as the other social parameter, to some extent, social was also there, but environmental parameters are something which are new in terms of being integrated into investor presentation, maybe reporting also, because in one or other sense, we understand that we have just started to ride this wave of sustainability related disclosures, or maybe we have started talking about capital which is conscious towards these sustainability related measures and all. So again, it poses a threat of greenwashing also. So because see, greenwashing may be intentional or unintentional. So what happens? I will not take a name like 2 years back, somebody has taken a target that we will have say 50% diversity in our board, for example, and they have quoted this target in the BRSR as well as somewhere in the presentation. And 2 years later, they come to a conclusion that it is not possible for them to achieve that diversity. Then they will drop this number. The other very relevant example, before I want you to answer, is that in one company's case, you mentioned about CSR. So there are two parts. It is not about investor presentation. It is about the annual report. So in one part of the annual report, integrated reporting, they mentioned that the number of lives that they've impacted was saying lakhs, 15, 20 or 30 lakhs. And when the numbers went in BRSR, it was in thousands, some 70, 80 odd thousands. And the reason which they've given was that we have shown cumulative numbers in integrated report, and we have given the year-specific numbers in BRSR, but the fact was not mentioned. So again, it will fall under the unintentional greenwashing. So is there any piece of advice which you want to convey to these companies, or maybe the ones who are looking at reporting, investor presentation, everything at all, to avoid greenwashing?
So, no, what you just explained, probably I would not put it in the category of greenwashing, but yeah, my advice would be that adequate disclosure should be made to explain the whatever is being disclosed by the company, because there are no standards. Which basically explain how things should be reported. So the onus is more on the company itself to explain what they mean, what they intend, and what they are actually trying to disclose. That's the only piece of advice I would give. In fact, Kuldeep, I know for that matter that you and your firm is expert in and helps many companies in preparing or improvising BRSR reports. So rather, I would request you to explain to the entire forum how this should be tackled.
So, sir, thanks for your words. So whenever so it is again my personal view, whenever we look at these factors, that what is to be identified. So we talked about KPIs. So I feel that the identification process is something which is very important. Point number one. Point number two, headwinds and tailwinds. Maybe whatever side of the progress we are standing at, we should disclose. In some cases, when we show these emission related KPIs or maybe disclosures in BRSR as well as investor presentation also, it may be a case that in a period the emission factors are going up, and in the other period they may be going down also. So both ways we have to show. Third, I feel is that interplay of capitals is very important, sir. So we always talk about financial parameters, and you mentioned also in response to one of the questions that sustainability related KPIs or maybe sustainability related measures that don't have any direct correlation to the profit or maybe the bottom line or the top line. But I feel that what additional an entity can do is to show the interplay of capitals, that how your financial capital, that is financial resources, are impacting the natural capital, that is your sustainability related measures, social relationship capital, and then the natural capital also, and vice versa. Because ultimately there is a relationship between these two capitals, finance. If you are taking any measures in terms of doing any social well-being, anything related to nature, anything related to diversity, etc., then you will have to spend money. So it is going to have a relationship, inverse relationship with the financial resources. Vice versa, as you said, that not in the shorter horizon, but in the long-term value creation process, it is certainly going to have an impact on your bottom line also. So this interplay of capital is something which is very, very important. Fourth, I feel that while taking these targets, so again, as we say that we are riding this new wave of sustainability related disclosures, I feel measures were there in earlier time also related to CSR or doing some social well-being, etc. But what is more important that while taking any target, so sir, in today's era, people are talking about SBTI, which is science-based technology initiative, and because it is going to give you weightage in terms of recognition or in terms of name in maybe local or global sector. You are saying that I have taken, you mean to say a company is saying that I have taken a SBTI target, whereas when you look at the ground level, there is no measure in terms of, first I'll say in terms of collecting the data. So if you don't have any such process of collecting the data, then validating the data, if you have collected data by XYZ, any mean or extrapolated the data by putting some formulas, there has to be a proper system of validating the data also. Without having these two processes, there is no point in having any sort of target just for the purpose of putting it in any report, because ultimately what is going to happen for a year, when you have taken that target or mentioned that target, your ratings or maybe your ESG scores may go up. But when it will come up to the performance evaluation part, you will have to, so if you have said that I am going to be, say, carbon neutral by 2030, 35, or maybe I am going to reduce the emissions by 50% by 2027 or 28, then time will come. At that point of time, you will have to be evaluate your performance in terms of what emission factors that you have reduced or not. So at that time, it is going to have a deep dive on the downward side. So it is very, very important that you take the targets which are achievable. It is applicable in financial statement also. It is more about it is more relevant or more similar to forward looking information. So I feel that in terms of financial parameters, forward looking information is giving a prediction about your top line, bottom line, or whatever business performance you want to give. In terms of sustainability related KPIs or sustainability related measures, it is about having right targets which are achievable. Otherwise, you are going to fall in this trap of greenwashing. And as you said that in your opinion, it is not a greenwashing. But sir, when you take an harmonious interpretation, as I also cleared this doubt in the beginning that it may be intentional, it may be unintentional. So it is on the receiver who is looking at your information, maybe an investor, maybe a regulator. They may choose to have a view that it is intentional. They may choose to have a view that it is unintentional, because the underlying assumption which you said about financial parameters, the underlying assumption about this non-financial parameter was not disclosed in the investor presentation, neither in the report. So I feel that these 4 or 5 points are very important in terms of putting in investor presentation, as well as a word of advice to those who are preparing the BRSR, voluntary or mandatory, that please have a look at the format. Even though it is tabular, but it has the liberty of putting the qualitative information along with the quantitative information. So because since it is very technical, it is very new in terms of adaptability in India, nobody is going to understand if you just give a plain table, because people will keep scrolling upward and downwards and they will say ki kuch samajh nahi aaya. So it is very, very important that you put qualitative information along with the quantitative information in all, at least in the leadership, in the essential indicators. So there are 2 types of indicators in BRSR. One is essential, which is in which you will have to either answer the question or you will have to give an explanation. Other is leadership indicator, which you can skip. So at least in the essential indicators, essential questions, you should give qualitative information. That is from my side. Virenchi, you want to add something to this?
Yeah, I think the only aspect is which I would want to add is on business sustainability, whilst the other ESG initiatives, which are more in relation to the uh, environmental friendly measures, is one part because of certain segments which are very vulnerable, like oil and gas, automotive, which are in the ICE segment, etc. The one of the messages which the institutional investors are always hunting for is what are your business sustainability initiatives. I mean, because that would impact the going concern of the entity at some stage. So that is something which probably will be of close watch in those specific segments. Again, the overall messaging may not be fully there in terms of the strategy from management side. Like for example, in automotive, there is no probably a full-fledged practical solution on how the vehicle disposal and scrapping would happen. But and again, from a ICE engine to EV engine, how the evolution would kind of take it. But these particular segments, if the companies are operating in the traditional manner, this will be a larger question. Probably at some stage they have to either answer in the investor presentation or maybe in the annual report. That to me is something fundamental that companies have to take care. Yeah.
One small addition to this, Virinchi, you talked about business sustainability. So I will say that while we disclose material issues or maybe business issues in our report presentation or annual report, wherever it may be, so there is very important concept of double materiality. So I feel that while you are assessing these material issues or maybe material topics which are important to your entity in terms of business, in terms of your operating environment, you should conduct this exercise of having the double materiality, which is that you should assess the impact of these issues on your business vis-a-vis the impact of your business on the sustainability related issues. So that whatever outcome you are arriving at is true reflection of your business sustainability related issues, as well as the ESG related issues which you are disclosing are related to your business. So it should not be in isolation that I'm showing that the temperature is going up, or maybe I'm talking about Paris Convention, I'm talking about what is happening around in and around environment, around pollution, etc. But it should be relevant to my business and how it is impacting my business and how my business is impacting these sustainability related issues is something which is very important.
Yeah. No, and one more thing I would like to add, as person from stock exchange. So you talked about explaining those numbers, Kuldeep. I mean, while that opportunity or possibility may not be there in the XBRL format, where the disclosures are being submitted to exchange, but in annual report, definitely it is your own disclosure, so you can add adequate narrative, adequate explanations. In XBRL, it's okay even if only the numbers are being submitted.
XBRL again, sir, it is for the purpose of internal evaluation. So it is not for the purpose of evaluation by the investors at large. And you have rightly said, where in XBRL we have to put an information, for example, yes or no. For example, if any specific question is not applicable, you have to enter 0. But in case of annual report, or in case of giving these presentations, you can very well have the opportunity and liberty to explain the issues. Qualitative measures should be given along with that.
There is one question, I think, from Mr. Nishant. For unlisted company who effectively regulates or oversees the factual accuracy of investor presentation, and what safeguard exists to prevent misleading information? Nishant, your question is little unclear. So are you talking about unlisted companies? Or are you talking about listed companies? As to what safeguards exist? I mean, if you're talking about listed companies, as far as safeguards are concerned, while SEBI has not prescribed any bare minimum what should be there in investor presentation, that's what we discussed so far. But yeah, in case a company is making any misleading information, general remedy is always available to everybody. If you are taking a decision basis the information being published by a company, and tomorrow it turns out to be factually inaccurate, the remedy is available in general law to anybody, and one can take a company to court for misrepresenting the information or misleading. I hope this answers the question.
Yeah, I think it's a listed.
I think follow-up question from him is, can retail investor fully depend on investor presentation and director report considering long-term investments? I would suggest investor presentation and director report or MD&A or annual report. All these things plays a very very significant role in providing information about the company, what management is thinking, what management's plans are there, etc., etc. Still, this is not an alternate to for the investors to do his own research, understand the business well, understand various other things, and it's not only about what the business. When you're investing in a company, you are also investing in the management. So understanding the quality of management, capability of management, their proven capabilities, execution of is very very important. That depends on who is there at the helm. We have seen companies, right, where once management changes, company turns around completely. So it's not only about the company, the operating environment. It's also about who is at the helm, who is leading, how the company is being led, what kind of institutional mechanism is being placed. Is it only dependent on one person, or the institutional framework has been created which um, will allow the company to be successful in long term. N number of factors are there, and there is no substitute for an investor to do his own research and understand the business management, company, macroeconomy, impact of it, and the environment in which company operates. There are various factors, so it's not only director report or presentation.
So I think in the interest of time, we will go forward. We have one more section to cover, which actually further explains the concern of one of the questions just raised some time back about the factual accuracy of the numbers. So the next set of questions is more on the governance and accountability in the investor presentations, Mr. Deepak. I think typically, what kind of structure do you kind of have seen in your own organization, on your experience, on what sort of governance mechanism and data checks and investor presentation goes through? Are there any best practices that you would want to share with the audience here? While you rightly explained that there is no set regulated aspect or certification or sign off on the investor presentation, but it will be helpful if you can explain in terms of what kind of safeguards generally you see. And one other aspect is, can you also clarify how this particular investor presentation in tandem also is something which company would already send it to SEBI as part of their regular filings, which also in one way means that every filing through SEBI in itself is in one way regulated and SEBI asks questions. That comfort also is something which is there or not, you can clarify. These are the two broad aspects, Mr. Deepak.
See, there is, because there is an unregulated space, so there is no standard in terms of what kind of governance an investor presentation should go through. But what I have seen, I know many companies, wherein when investor presentation is placed before audit committee and they look at it, and then it is along with financial result, it is disclosed to exchanges. But I would say that could be the best kind of governance. Though at the same time, let me also admit, even in BSE, we are not putting it to audit committee. But yes, at internally, we apply the highest standard of checking, ensuring that the information which is being presented in investor presentation is accurate and giving the right view about the company. So there's the kind of check we carry out, but there is no standard practice. I would say that the best would be if it is also presented to the audit committee along with financial results for audit committee to also appreciate. Some time ago, I think that regulation still continues. MD&A is supposed to be looked at, the financial numbers which are being presented in MD&A, and not only P&L financial number, other financial numbers, if they are being presented in MD&A, have to be looked at by auditor. So that can be another thing. If any other financial number other than what is supposed to be published as per LODR format is published in investor presentation, companies may voluntarily adopt, wherein they are also checked by auditors. But that should be purely voluntary, as I said, because ultimately the onus of ensuring that information is accurate, consistent, correctly present, and is also understood by investor correctly is on the management. Right. So it's for management to decide what kind of governance structure they should have to ensure the accuracy and transparency.
So again, being in audit profession, we can tell you that we are not covering this under any angle, including being it subjective. It's not part of other information is the call. Generally, a lot of large firms have taken, but I think from the best practices, what you have suggested, I have also seen where functional heads generally take ownership on the data points. They go through the finance controlling team and the investor relation team along with secretary team generally vets this information. Then it goes to CFO. So generally we have seen 2 3 layers of checks. Like you said, again, mixed practices as far as the board is concerned, but definitely functional leads and financial control team and CFO and MD up to that level, we have seen examples of companies going through this documentary checks. Yeah.
So, Rinchi and Kuldeep, if I may request, because we are running short of time and I have another meeting to attend, if we can wrap it up, it'll be really.
Yeah, I think we've answered a lot of questions as well in the process, and we have Kuldeep, anything from your side to add?
And I think we are good to go. If there is any other question from any of the audience, we can take. Otherwise, I think we can wrap it up. So what else also can be done if there is any other question from any of the participant who is there, they can drop an email to the committee itself, and then committee can reach out to Deepak sir or Virenchi or me, and then we can spare some time and we will try to answer those queries also. Because ultimately it is not possible to answer each and every query over a webinar. Also, it is not possible. There might be a query which will come into the mind of the participants after some time. They are free to drop their queries over email to the committee. Over to you, Saman.
Thank you so much, gentlemen. It was a very learned session. I'm seeing, I think, the questions that have been put forth by the participants. I'm sure everybody had an enriching session. I thank our learned speaker for the day, Deepak sir, and our two very distinguished moderators for the day who help us sail through this conventional topic. Thank you so much. And committee will be back with another series on this similar topic for more learned experience of our members. Thank you so much, everybody. Good evening.
One small thing, Saman.
Yes. Yeah.
Deepak sir, kudos to the committee, also the secretary of the committee, as well as the chair and vice chair. I think this is the first webinar, maybe this kind of webinar has not been organized prior to this webinar on this specific topic. So investor presentations are part of our day-to-day communication life with the listed entities from so long, but this is the first webinar. And we are, I would say we are blessed to have you also among us, Deepak sir, and a very good company in form of Virenchi, very experienced audit professional. So all in all, it was a very good beginning to this series of webinars, and hopefully, as someone has said, we will have some more webinars on this topic coming forward. Over to you, Deepak sir.
Thank you very much, Kuldeep, Rinchi, and Samandeep, and thanks for your, I would say, inquisitive questions. I mean, some of these questions actually forced me to also think about, how things should be there. Because in day-to-day, when you are working, you really don't sit and think about various questions, various aspects which you talked about it. So thank you very much for all those questions, and glad to be part of this discussion. Thank you.
Sir, it is always beneficial for us. I would take this liberty to speak on behalf of Virenchi also as an auditor as well as a consultant to interact with business CFOs or business leaders like you. So we understand the other side of, understanding also, the other side of table also. Otherwise, we are just on our own. If we are auditors, we'll think from our side. If we are consultants, we'll think from our side. But what is more practical and what is more relevant to a business is what you guys tell us very, very, in a lucid manner.
I'm glad you found it useful. Thank you very much, Kuldeep.
Thank you.
Thanks a lot. Thanks a lot, everyone.
Thanks, everyone.